Welcome, everyone. Appreciate you being here. I am here with Liz Reese of Reese Squared Mortgage. She is known as Loan Lady Liz on the socials. So welcome, Liz. And I kind of just want to dive into if somebody's going to buy a home, whether it be the first time or maybe they're a little bit more experienced. Obviously, I think the first-time home buyer is going to need a little bit more hand-holding, but just kind of talk about the loan process, and just kind of gather like a comprehensive understanding of what is expected in the loan process, and maybe help somebody that is buying a home understand the ins and outs and the process that is involved with buying a home.
Sure, so you bet. And I want to jump in here if you don't mind, Rob. You said something I think is really important to address. So that first-time home buyers need a lot of hand-holding, but I will say that maybe you haven't bought a house in 20, 25 years. Like, the process is really different now than it was maybe when you bought a house 25 years ago. And so I think it's important to, like, everybody needs their hand held a little bit.
Yeah, no, I think that's great advice. I think that's important to know, because things have changed dramatically in the lending industry, especially if you haven't done anything. I mean, there's drastic changes that happened in 2008, 2009 that really kind of changed things and how things work. So, and let's be honest too. I mean, the lending world and how things, rules and regulations, they change quite regularly. So,
right.
I think that is a very good point. So, it is important to those that are in the process of finding a house and looking for it to kind of understand their financial situation and going in with their best foot forward when buying a property. So it's good to understand where you're coming from in buying a property. So let's just kind of jump into it. I've got some questions here that I'd like just to kind of talk to you about, and we'll go from there. So Liz, what type of loans are available for people out there looking to buy a home right now?
Yeah, so if you have a really, really traditional income, you have a W-2 job, maybe it's salaried, there are conventional loans. Those are, I guess, the one you hear the most familiar with, that the most people want. But there's conventional lending, 30-year fixed, all different terms of the years. There's adjustable rate mortgages. There's also government loans like FHA, VA. People are really familiar with those. If you're self-employed, you can still get these types of loans depending on how your income is. It really just depends, and it's really important to talk to a loan officer, depending on just to see what your overall picture is. But if you're self-employed, they have special loans for those circumstances as well. And then even for seniors, they have what are called reverse mortgage, and those are loans that help in a different way, but they're only for like a certain age group of people. So
what about like people that have served in the military? Are there any benefits? Are there any specific loans for veterans out there?
Yeah, so that's a good question. There are VA loans, and the benefit of a VA loan is that they can do 100% financing and also not have to pay mortgage insurance. So mortgage insurance is something that you pay if you put less than 20% down, and it's insurance that benefits the lender in case you default. So that's the purpose of mortgage insurance. But the VA is willing to take on that risk, and so they do not charge you mortgage insurance as part of doing 100% financing. Now, part of the government loans is there's a government fee for doing those loans. If you're a veteran in particular and you have a disability, like you get a disability benefit, that government fee is waived. Otherwise, they can be, they're fairly substantial. They can be financed into the loan, so you won't really feel it, but it is part of the transaction that I think is important to just at least to know about.
Okay, what about like first time home buyers? Like in order to qualify for like an FHA loan, do you have to be a first time home owner?
No, you don't have to be a first time home buyer for FHA, VA. The benefit, a lot of people feel like there's a real big benefit to being a first time home buyer. And I will say the benefit to that is that depending on what area of the country you're shopping in, you can do as little as 3% down. If you're in a very expensive, like they would call it like a high balance area, like you're San Francisco's of the world, New York City, probably, different, probably more urban areas, you're going to have at least 5% down. So, but otherwise, there's kind of if you're a first time home buyer, maybe if you need down payment assistance, there's programs out there that are only allowed for first time home buyers. But otherwise, like, you don't get better rates or cheaper insurance or anything just because you're a first time home buyer. So.
Okay. So anything else that you'd like to add about FHA and how FHA loans work?
Sure, yeah. I think that a lot of times people think FHA loans, you're going to get the best deal. And I think that FHA loans do have a purpose and they are helpful in some circumstances. In my opinion, if you can go conventional, that is the cheapest, I shouldn't say cheapest, but the least expensive way to go, because again, the government loans like the FHA has it's upfront mortgage insurance premium is what it's called. And depending on what your loan amount is, it can be like a lot. So I think that if you can go conventional, I would go conventional. The benefit of FHA is they are a little more flexible on credit score and debt to income. So you might qualify for a more expensive house going FHA because they'll allow you to have a little bit more debt to qualify.
Got it. So let's talk about the terms of a loan and how that affects my monthly payment.
Yeah, so there's all different terms of loans. Actually, there's 30-year. I mean, the most traditional people you're going to think is a 30-year loan, and that allows you to have a house payment that's going to be paid off in 30 years. And that's going to be your cheapest option on a monthly payment basis because it's spread out for so long. But you can do a 15-year, a 10-year. Us in particular at Reese Squared Mortgage, we can actually do any term that you want. If you want a 17-year loan for whatever reason. But actually, and I think that's really helpful when you do a refinance. If you've been in it for 2 years and you don't want to start all the way over, you can do a 28-year loan. So I know that's kind of getting into the weeds a little bit, but yeah, there are such things as adjustable rate mortgages.
So let's talk about that. What is the difference between a conventional loan and an adjustable loan?
Well, not conventional, but fixed.
Sorry, I misspoke. A fixed loan as opposed to an adjustable rate mortgage.
A fixed mortgage is going to be fixed. The interest rate is going to be fixed the entire term of the loan. So if it's a 30-year term, that is the payment on the loan for 30 years. Your taxes and insurance might change, but the payment on the loan itself won't change for 30 years. An adjustable rate mortgage is fixed for a certain amount of time, and then it can adjust after that time. Sometimes people can get into those and the rate's a little bit less, and that's why people want them. Back in 2000, before 2008, the adjustable rate mortgages were a lot cheaper than the 30-year fixed ones. It's not so much like that anymore, I don't think. Or if you want, you can get a lower rate with them, but they're still really expensive. So it's important to work, I think, with a loan advisor who's not just pushing your paperwork through the system, but really able to strategize. Does this make sense? So. And
that adjust the rate, adjusting on an adjustable rate mortgage, that can adjust either up or down depending on kind of what the market's doing, correct?
Oh yeah, for sure. Like when we were, so Rob and I are married, and when we had our mortgage at our first house, it was an adjustable rate mortgage, interest only. which sounds so scary, but it was such a huge blessing because during that original crash, in that
2008, 2009.
yeah, that crash, the interest rates actually came down quite a bit. And because we had an adjustable rate mortgage, our payment was going down too. So that was because we were also in lending then, and it was rough. So it was a huge blessing. So it sounds scary, and sometimes it was for a lot of people, but we just happened to I don't know, we just lucked out, I think.
So, yeah. So, I mean, I like you said, I think things are different now than they were when we were in an adjustable rate mortgage. I think the rates were they were substantially different.
Yeah.
From
maybe 2%.
Yeah, it was quite a bit different.
Huge.
But now, I mean, that's not really the case. I mean,
Right.
to be honest with you, I don't know why. I mean, if you can qualify for just a regular conventional loan, fixed rate, I don't really see a point now, currently, as of this recording, why you would want to do an adjustable rate, because it's not.
Yeah.
They're not that different.
I priced one out yesterday, and it was the adjustable rate mortgage was 0.25% cheaper, or not cheaper, but less than the 30-year fixed was. And the cost difference was, it was like an extra $2,000 for that adjustable rate mortgage. So it wasn't like, I'm not saying $2,000 is a lot of money, but it just wasn't so vastly different in what the interest rate difference was that it was worth even considering, I think.
Yeah, that's kind of what I've kind of seen as well. So let's talk about down payment. I know we talked about it a little bit, but let's delve into down payment a little bit more, and how that affects the loan terms, if at all.
Yeah, so your down payment is going to affect a lot. So your monthly payment, your interest rate is really affected by how much money you put down, and also your credit score. So the more money you put down, the better. There is kind of a limit at what point it stops getting better. If you put down 35%, if you put down 60%, there's not going to be a big change in that difference, right? Like, it kind of caps out, I guess. But, most people don't have that. But the more you put down, the better different parts of the loan get. So you might get a better interest rate. Your mortgage insurance might be cheaper. If you can, first-time home buyers, they can do 3%, but if they'll put down 5%, it makes their mortgage insurance every month be, maybe $50 a month cheaper. So there's a benefit to just, if you can squeeze out a little bit more of putting a little bit more down.
So on an FHA loan, what's the requirement for a down payment? Because I think people always talk about that, go FHA because it's the least that you have to put down, and that's not totally accurate, as you mentioned, because if you're a first-time home buyer, you can go 3% as opposed to, what is it with FHA?
So FHA minimum is 3.5%. And this is actually really great if you are in an expensive area like San Francisco, Los Angeles, because that first-time home buyer conventionally has to put down 5%, but if they go FHA, they only have to do 3.5%. So even if you're like $1 million property, you could do it on 3.5%. Your payment's going to be very big, but you can have, if the payment's not a big deal and you don't have a lot of cash, it's an okay way to go.
And then you talked about with VA, I mean, they can go up to 100% and also finance their closing costs with that as well. So
they can finance the funding fee. Sometimes you can finance the closing costs, not always.
Okay.
But, yeah.
But 100% financing.
100%. Like if you buy $1 million house, you can get $1 million loan on a VA with no mortgage insurance premium.
That's pretty awesome.
Yeah.
I actually think that if you are a vet and you have a disability where the funding fee can be waived, to me, there's no better loan in the world, because you get the benefit of the VA interest rate, which is typically less than a conventional loan. You can go up to 100% financing, and there's no mortgage insurance. It's like the perfect storm of everything, combining in one. So Vets, if you're out there, I mean, and you qualify for a loan without the funding fee, like, I mean, that I think is a great loan for vets.
Yeah, and even like to dive a little deeper on the VA loan, even if you don't qualify to waive the funding fee, and just know like the disability.
Well, it's still a great loan.
Yeah, the disability doesn't have to be huge. It can be maybe just a smidge of hearing loss, and maybe your VA, the disability benefit is just, not a ton of money. Like,
and how would you know if you're a vet that you would qualify for the funding fee being waived?
You would, I think when you're a veteran, that you're a disabled veteran. Usually when you're disabled, you get money for it. So it may not be a lot of money, but my point is it doesn't have to be like you're missing a leg or something. Like it can be, I've had veterans that got $75 a month in a disability benefit, and they had a little bit of hearing loss. So.
But isn't it on the DD-214, if they're exempt on the DD-214, if it says exempt on there, then they are exempt from the funding fee, correct?
I actually do not know. That's a good question. It's either on that or the certificate of eligibility. It's probably on the certificate of eligibility. So off the top of my head.
Somewhere it will say that they're exempt.
Mm-hmm. Yeah, it'll say on, yes.
Whether it's the DD-214 or on the certificate of eligibility,
Yeah.
it's one of those two. I can't remember off the top of my head.
Yeah, it's the certificate of eligibility, I'm fairly sure.
Okay, awesome. Are there any first-time home buyer programs that I could take advantage of if I'm a first-time home buyer, or grants that are available out there?
Yeah, you should definitely check with the state that you live in. Just Google it, first-time home buyer program in the state. California, there's a variety of programs in California. That's where we are at. Also, I'm licensed in Utah, so I know that there are programs there. Also, look inside your city themselves, because sometimes cities are trying to encourage people to move there, and so they will have down payment assistance programs that are just for that city. It's not, or the county. So there are things out there. I think it's really important to know that it's very likely not free money. Sometimes there will be a grant out there. I think there's one right now that's like, they'll give you $5,000 to $7,000, which is helpful. It's, it's not nothing. But it's important to know, typically with down payment assistance, it comes at a cost, whether the closing costs are higher, maybe the interest rate is higher. They might have rules about how much money you're allowed to make to qualify, like have income limits. So, something to keep in mind. In my opinion, if you can just figure out how to bring in some of your own money and not use down payment assistance, I think that's the way to go. But if that's not an option and it's the only way to do it, it's at least out there. So, but know that like you have to live in that house. So if you're of the mindset that you're going to buy a house and then turn it into a rental and go along down the lines and create this like empire of real estate, you're not going to be able to do that with these down payment assistance programs unless you refinance out of those loans and then buy another place. So
okay, good.
Yeah.
What should I expect as far as closing costs are concerned with a loan? What am I going to be responsible for paying? Closing costs, I mean, is there a processing fee? Is there an origination fee? Appraisals, inspections? What should I expect as far as costs are concerned when buying a home?
Yeah, typically a good rule of thumb is going to be to figure 3% of the purchase price as closing costs. I do think.
Does that include everything? Closing, is that just the closing costs, or does that include like any origination, any appraisals, any inspection fees? Would that 3% include all that as well, roughly?
Well, the answer is it depends. So,
Okay.
I mean, it could cover inspections. I do think in some cases 3% is a lot, and my advice is usually just count on the 3%. And if you have leftover money, nobody's ever sad about leftover money. Use that to buy a lawnmower for your new house that now you get to do yard work, So I think as a general rule of thumb, 3% is a good way to go about it. There are some costs of purchasing a house that are connected to the loan, like the appraisal and the escrow and title. If you're an attorney, an attorney, and some that are outside of the house. So you're gonna have like an inspection, and depending on like what kind of house you buy, like you might need a roof inspection, you might need a sewer lateral inspection, you might need if it's like a rural property, like a septic tank inspection. So there's those kinds of things that you need to keep in mind. Those are paid for outside of like the lending part. But
now, is there a possibility of being able to finance any of those closing costs into the loan of the home?
Not generally, no. You can ask the seller to help pay some of those closing costs. So that's certainly possible.
So in negotiating with when you're putting in an offer, you could write that into the contract where the buyer might pay for some of those closing costs,
yeah.
Or
you could ask for $10,000 or more or less. It's important to work with your real estate agent to get good advice around that. There's a lot that goes into, is that a good idea? Does it make our offer competitive? How can we, maybe there's a win-win for both parties. So yeah, that's the benefit of a real estate agent, is that they can really help advise you around if that's a good idea.
Okay, let's talk about not interest rates, but let's talk about credit scores. Is there a minimum credit score that you need? And does my credit score really affect the terms of the loan very much?
Yes. So credit score is like the higher the better. So we kind of 800 is what people like to aim for. I'll be honest, I don't see a ton of 800 credit scores, but when you're looking online, I'm trying to think of like there's like, maybe your bank gives you a credit score. So there's 3 bureaus that we look at. They each have their own score. We don't take the highest score. We don't take the lowest score. We take the middle score of those 3. So usually when your bank gives you a credit score, it's just, it's like one of the 3. So it gives us an idea. It'll give you an idea of where you're at, but it's not going to be your whole story. Credit score affects your interest rate, affects how much your mortgage insurance is. I'm trying to think. What else did you ask?
So I just asked, is there a minimum credit score that we need?
Yeah, so minimum credit score ideally is 620. We can go lower. It just gets sticky. So if you can get your score above 620, you're going to get a better deal on a loan. I think we can go to 500 with one of our lenders, but I mean, you're going to pay for it. So it's rough. Keep your kids, pay your credit cards, pay your bills. Yeah. And if you have a mortgage now, like, don't be late on that mortgage, because that will take your score. It'll drop at 100 points that first 30-day late. You're toast. So it falls fast and it heals very slowly.
So what would you need from me as a first-time home buyer, or just anybody getting a loan, to get pre-qualified or pre-approved for a loan?
What we need from you, if you are a W-2 employed person, and there's 2 of you, this is going to apply for both of you. So we need 1 month of pay stubs, 2 years W-2s. We need 2 months of the bank statements or asset statements, wherever your down payment money is coming to buy the house. We need 2 years of that. We need ID, so like a picture of your driver's license. And I think that's it. Pay stubs, W-2s, bank statements, picture of your ID. If you're self-employed, we need to see 2 years of your tax returns, personal and business. If you own other properties, we need to see their, if it has a mortgage on it, we need to see the mortgage statements. We need to see the tax returns for that, because if we have rental income, we need to see that.
What about the lease agreements?
Lease agreements, super helpful to have those. We need the insurance and the tax statement. and like if there's an
Property
HOA,
tax statement?
property tax statement, yeah, question. And if there's an HOA, we would want an HOA statement. So that's at least a very good starting point. It may be, when we get a loan in and we turn it into the underwriter or the lender, they look at it, they might have more questions. So they may ask for more things, but it's a good starting point.
Is that pretty common that you'll turn all this information into the lender, it gets underwritten? What's the likelihood of the underwriter coming back and asking for more information?
Very high. It may not be a lot of information. Sometimes it is. It depends also on the type of loan you're getting. Sometimes these loans for self-employed borrowers or investors, they have tons of questions, so we have to answer those. But I have a refi right now that they just came back and just needed two things, and it had to do with their current loan, making sure it's been paid for 12 months on time. So it's it just depends. It's important to know we need all the pages of everything. So if your pay stub is like a front and back paper,
and the back page is blank,
and the back page, if the pay stub says one of two pages, we want two pages, even if the second page is blank. Same with the bank statements. So just send all of it in. Yes, we need the entire tax return, even if it's 80 gazillion pages. They want it all.
But sometimes when you turn things in, it does create other questions that the underwriter might want some additional information for.
They're going to look at your bank statement. They're going to look at the bank statement. Like they're going to see what are the transactions. When we bought the house we're in now, there was a line in our bank statement that said it was an outgoing, like a transfer, and it was labeled for car payment. But on our credit report, we didn't have a car payment. And so they asked about that, like, do you have a car payment? Because this bank statement says there's a transfer for a car payment. And so we didn't have a car payment. I just had to write a letter that said it's a savings account that I deposit money, I transfer every month into to save up for a car. So that was all that was.
And so I think that's good to know that sometimes you just need an explanation, and writing a letter of explanation and getting that signed by the borrower will satisfy sometimes, some of those questions at times. So, yeah. Typically, how long does the process take?
The process to get pre-approved, or the process to once your offer is accepted?
Well, let's go with getting pre-approved first.
So the process takes, to some extent, the amount of time that you get us the document. So let's just say you're just Johnny on the spot, you get it to us fast. Usually 24-hour turn time is pretty typical. If your income is very complicated, then it might take a little bit longer, because we may have to reach out to your employer to get a little bit more detailed on where the income is coming from. Income is not cut and dry. Just because you look at your paycheck and you're like, I make $10,000 a month. Well, if $7,000 of that is your salary, and then $3,000 of that is your overtime or a bonus or something like that, like we really have to look at your income on a 2-year span. So sometimes it takes a little bit longer, but it's mainly about income. Yeah, and like nurses' income's complicated, firefighters, police officers, like some people's income are just, it's, if you're a nurse that you have 8 different ways you get paid,
So we're talking about the process and how long the process takes. Are there anything that could cause delays in the process?
There's always something that could cause a delay. An appraiser could take longer than expected. We have somebody right now who their taxes have been turned in but not received by the IRS, and so that's caused a delay in this transaction, because in order to be accepted, the taxes to be accepted, they have to have been received by the IRS. So there's things like that. I mean, if when the lender asks you for something, you should get it to them right away. You know, sometimes I get that there are some things out of your control that you can't produce right away, but you should try to act. The faster you act, the faster we can get it done. Like,
So are you saying like within the next 24 hours? Are you saying by end of that business day? Are you saying within a couple hours? What would be ideal?
I mean, ideal would be like, hey, Rob, I need this. And you're like, okay, here you go. And you send it to me right away.
So like while I'm on the phone, hey,
best.
hey, Rob, I need your bank statement. I hop on my bank statement. I download the statement and I send it over to you.
If you could do that, that would be fantastic.
That would be ideal.
Yeah,
okay.
yeah, that would be ideal. But I mean, sometimes you just can't control some of this stuff.
How often
right?
does that happen?
Never. It never happens.
That's not true. It does happen.
Well, it does happen.
It does happen, but it's not very often.
It's not very often.
The good faith estimate or the loan estimate, is there a difference between those two, and do you provide those?
So the good faith estimate is something that it kind of sunsetted with the whole 2009 TRID debacle, which I think is not really this conversation so much, but so now what they have is a loan estimate.
So the loan estimate has replaced the good faith estimate.
Yes.
Okay.
And that's a good thing to know. If you bought a house a long time ago, then you're like, where's my good faith estimate? Like it's called the loan estimate. And that loan estimate is going to come to you at the very beginning. It's important to keep in mind it is an estimate, but it'll tell you like if your loan is locked, it'll give you kind of some fundamental things. The things that make it an estimate are, you know, you don't probably have your insurance quote yet. So if the taxes are coming due on that property, then, you know, they're going to show that those need to be paid right away. But when you dive into the loan a little bit more, there's going to be something called a closing disclosure. That disclosure will have by then figured out that the seller is going to pay these taxes and this is what the escrow fee is. And, oh, you got your insurance? Great. We'll adjust that and put it in here. So the closing disclosure will more accurately give you what things end up being. So the loan estimate gets it started. You really just acknowledge that you've seen it, but you just know that those numbers will be different going on because they'll get tightened up. So
Liz, what happens if in 5 years, I've been in there, I bought a house, I've been in it 5 years, and I win the lottery. Is there any penalty for paying off the loan?
Well, you have to contact me and give me a little cut of it. No, there's no, well, I shouldn't say no, because we just did one where they do have what's called a prepayment penalty, and their prepayment penalty is 5 years. So this borrower in particular, it's an investor, it's an investment loan, which is, you know, a whole other conversation, but this type of loan does have a prepayment penalty. But typically your regular homeowner buying a house that they're going to live in, there's no prepayment penalty. So you can pay it off anytime.
So if I'm in a conventional loan, I can pay that off at any time.
Yeah.
How about with FHA? Can I pay that off at any time?
Yes.
Yeah.
VA? VA, same thing. Yeah, it can be paid off anytime.
So you're really kind of talking about kind of these prepayment penalties. I mean, they're kind of a niche product, right?
Yeah.
I would say the majority of people are not going to be in that. Most people are going to be in your conventional FHA or VA loan, and it'll be spelled out to you pretty clearly that there is.
Yeah.
If there's a prepayment penalty, somebody should be talking
clear
to you, and it should be very clear that you have a prepayment penalty.
Yeah.
I would say probably 95+% of the loans, I mean, you're not going to be in a prepayment penalty.
Right.
But it's always a good question to ask.
Yeah.
Doesn't hurt. Sure. And how often do I need to make a payment on my mortgage? And if I were to make additional payments, is there any penalty for doing that?
So your mortgage payments due once a month, and it's usually it's due on the 1st, late by the 15th. Being late, like if you pay so you have 30 days to pay your mortgage. You have a grace period for 15 days. If you pay it after 15 days, there's a late fee. If you pay it after 30 days, a 30-day late is a terrible idea. That will hit your credit score, and it'll dump your credit score. My suggestion to you is if you can't make that payment for whatever reason, you need to call your lender and talk to them about it and see if they can give you some kind of put you on some kind of it's called a forbearance plan, where you don't have to make the payment. You have to have a good reason. It's not just because you don't want to. But they will typically, if they'll allow it, they will put that money that's due on the back end of the loan or to the side. So when you refinance, it'll have to be paid off at that time or something like that.
So like if maybe I lost my job, there's a possibility of calling my lender and maybe getting on a forbearance program. Yeah. I know that like during COVID, banks were offering some kind of a forbearance during COVID for a lot of people, depending on their circumstances. Right. Maybe what about if I got sick or one of my kids got sick and again, maybe I can't work or things like that. I think it's best, like you said, just to call the bank and see what options are available as opposed to just not making your payment. Right. They might be willing to work something out with you.
Right.
Awesome. So as we're going through this process, we've talked about interest rates. You've quoted me a rate. The loan hasn't funded yet. Is that rate that we talked about, is that going to change, or is that guaranteed that I'm going to get that rate that we talked about when we started the process of getting a loan?
Yeah. So your pre-approval rate is not locked. So that is one of those things that if you get pre-approved and then you hear a lot of sort of media things about rates are going up or whatever, like just, your loan officer should be in touch with you, but also you need to just be a little bit aware that your rate could have gone up, which may make what you qualify for be less, because that affects your payment, right? But once you get into contract, that is when you'll lock your rate. When we have an
And when you say lock, what do you mean by that? What does that mean? Locked my interest rate.
That means that is the interest rate that you are going to get. We are telling the lender, this is what we want. Lock it in, reserve it, whatever you want to call it. We've locked it in, so this is what, and it'll be fixed for a certain amount of time. So we have to get our loan done in that 30-day time period. Usually is how long you lock it for. It can be extended if it's needed, but only maybe 30 days max, and that comes at a cost. So we can typically get the loan done in 30 days. So it's not really something we are so stressed about, but it's important to be aware of that your rate is locked in once you have an address and we're moving forward. Your offer's been accepted. We have 30 days to get it closed.
Okay, cool. What happens if we do an appraisal and the appraisal comes in less than what my offer is on the house or what we've agreed upon to pay?
Depending on how you've written up your offer and they've accepted it, you can renegotiate with the seller to see if they'll bring the purchase price down. If you've waived the they call it a contingency on your purchase contract, if you've waived the appraisal contingency, you're saying, I'm willing to pay this much for the house no matter what it appraises for, and you have to come in with the difference in what it appraises for versus what your purchase price is.
Are there any options if I can't afford the closing costs?
Well, if you can't afford closing costs, there's a few things that you can do. You can ask the seller to help cover the closing costs. It's called a seller's concession. So there's a few ways that your agent can really advise you around that. Sometimes it's just as simple as if you need $10,000 in closing costs, maybe you offer $10,000 more on the purchase price and ask for that $10,000 to be a concession to pay for your stuff. Now, if the appraisal comes in and not at that $10,000 higher amount that you offered, then you probably are going to have to say, oh crap, I don't have the money for the closing costs. So that's the thing you just have to be careful of, is that it's still going to have to appraise. So if you offer more than asking price to cover that, it's still got to appraise for it. So Sometimes people don't realize that you can use your 401k to help you buy a house. You are allowed to borrow from your 401k to buy a house without a penalty. You need to talk to your 401k company. They usually only allow you to borrow so much of it. It does generally have a cap. Usually the cap is around 50,000, but every company's different. It's important to know that you will have to pay that back. So you've got to kind of mentally calculate that in your head of like how much less your paycheck's going to be, because it'll be paid back there. You can do a hardship withdrawal from it, but there are tax consequences from that. But you can get a gift from family members. That is something that maybe not everybody can do, but you might be surprised. Your family, your parents, they may want to help your grandparents. So, but it does have to be family members.
So I can't get it from my girlfriend?
You could maybe. So if it's like your fiance, there's a way to maybe frame it, but yeah.
So if I was getting married and my fiance were to give me a gift, that is a possibility.
Yeah, for sure. But like
But my best friend growing up
buddy,
that has lots of money and is willing to give me a gift, that's not going to fly.
Right.
So pretty much got to be family or like a fiance that will eventually be family shortly.
Right.
All right, awesome. Tell me about the escrow process, and are there any costs included with escrow?
So escrow is the one who holds the money. So your escrow officer is the one that you're going to give them your deposit. So your offer gets accepted. You agree that you're going to put down so much money as a good faith deposit on the house. And depending on how your contract is written up, if that contract gets canceled, either you don't qualify for some reason or I don't know, something happens, you'll get that money back. If you get too far into the loan, you might lose that money. But escrow is the one that holds that. And they're the ones that talk to the lender. So when the loan funds, all the money from that funding goes into escrow. Then escrow gives it to the seller. So escrow is the one that holds the money. Their fee is dependent on the area that you're in. It depends on the purchase price. What's included in that. I don't know exactly what's included in that fee because everywhere is different and different parts of escrow are, there's little nuances inside of it. So, but escrow is the one who holds the money. Mm-hmm.
Okay. Earlier you talked about employment and needing, like a 2-year history of employment. How would that be verified, and how would my income be verified?
So we look at your income. You'll send us 2 years W-2 and 1 month of pay stubs. Now, if maybe you just switched jobs and you don't even have a first paycheck yet, we'll need an offer letter helps. Maybe you've moved from somewhere else and you're new here. We'll get an offer letter. We'll usually identify what your income is going to be. If you can get the last pay stub of your last job, sometimes that helps. So
what if I was like a nurse or a police officer? You mentioned firefighter. There's lots of overtime. Like, how do you calculate that, or how do you verify that?
There's a few ways. So the fastest way is if you can get the very last paycheck of the year for 2 years, then we can calculate an average of 2 years off of that paycheck, because that paycheck will have like what you got paid for your entire shift differential for that whole year. And so we can see that in the average of that last paycheck. But if you don't have that, not everybody can access their paychecks online or hangs on to them. They're not that organized. We can just we can ask the employer for what's called a verification of employment, and they will break down your income for us. And then we can do the averages from that.
All right. Last question. This is a doozy. Is there anything that I should avoid doing during the lending process?
Yeah. So it is very exciting to get into contract, and you're like thinking about how you want to decorate your house, and you need a washer and dryer and maybe a refrigerator and like all of those things, like,
or a new car to park in the driveway.
a new car to park in the driveway. Don't buy anything on credit. Don't open any credit cards. Don't co-sign on anybody else's debt. Don't go buy a new car. Or what I will say is, you might be okay. I've definitely had people who have wanted to go buy a new car, and I'm like, all right, what's your payment going to be? We calculate in the payment. Okay, you just cannot buy a car with any more monthly payment than this. So, it kind of depends. But like in general, a good rule of thumb is like, don't have your credit pulled, because that can make your credit score go down. And if the lender pulls your credit again and it's gone down, then like the interest rate could change or it gets more expensive. Like, it's just, if you could just wait until after the house closes to do anything, to buy anything on credit, that really is the best thing to do. So don't buy anything. Don't change jobs. That's a big giant pain in the neck when people change jobs during the process. If it's a job that you're getting paid more, then sure, maybe that would be okay. But again, you should talk to your loan officer, because it depends what type of income you have on whether or not that's a good idea to change jobs or not. So
before you go getting any new debt or buy anything or change jobs or anything, contact your loan officer and make sure that that's not going to have any drastic changes to the outcome of you getting a loan, because there certainly have been people that have purchased a car in the process and it's blown up the loan and you're out of luck.
Great,
so
you no longer qualify. So you're gonna have to get a co-signer or something. Like, it's just, or you just don't get the house now, because now you get to live in your car.
So wait until the process is over and do that. I think that's the best advice, is don't do anything drastic when you're in the process of getting a loan. Don't add any new debt. Don't co-sign. Don't buy a new car. Don't go out and get all of this new furniture to put into your house, washer and dryer, refrigerator. Wait until the loan is closed, because that potentially could cause some major issues in the process of funding that loan. So best advice is wait till the end and it's funded and you've got the keys to the house.
Yeah.
Awesome. Well, Liz, I appreciate your time. I think it's very important that people are educated and understand the loan process and what they're doing, what they're getting into, and how this works. So this is great. I appreciate your time and appreciate the education here. So thank you.
Yeah. And if anybody wants to learn more, you're wanting to buy a house in California or Utah, actually, then, just...
What's the best way to get a hold of you?
Yeah, my number is 209-640-1710. You can follow me on, Instagram's my jam. So, but anywhere that you prefer to be on, I'm Lone Lady Liz on TikTok, Facebook. Anyway.
All right. Appreciate your time. Thanks so much.
You're welcome.
All right.